Hello and welcome to a brief talk about volatility and liquidity in the energy markets and how we in the energy team at CCS are managing their impacts. My name is Dan Tatlow and I'm a risk manager in the trading and risk team. I'm joined by my colleague Michael Prince, a risk analyst on the team, who will walk you through some of the details today. So general situation, people will of course be aware of the general movement of gas and electricity prices over the last couple of years with so much media attention. Wholesale prices shot up to unprecedented levels in 2022. They've since fallen somewhat away from the peaks, though they're still high compared to levels before the crisis. These high prices are not just from what retail suppliers are charging. The wholesale cost of the energy itself rose to extreme levels. So we at CCS buy the energy demands for customers up to several years ahead of when the actual energy will be used. And we do this using forward contracts for wholesale gas and electricity. The prices of these forward contracts increased as well as the prices for energy at any given time. At CCS, we work to hedge customers' energy requirements of several years ahead, as I've mentioned. This is done to mitigate the risk to customers of exposure to periods of high prices by spreading out the buying of the gas and electricity that they'll be using. We refer to the length of time for buying these volumes as the purchasing window. We have a number of different strategies with different purchasing windows, and each of our customers signs up to these based on factors such as risk appetite, length of contractual obligation, things like that. For example, we begin purchasing our locked 12, L12, strategy 12 months before the start of the financial year in which the energy would be used, and complete all of the buying by the end of January to allow our suppliers to issue pricing to customers ahead of the start of the financial year. This purchasing window is demonstrated in the chart you'll see on the screen there. The cost of energy for customer bills in the delivery period is reflective of the market prices across that purchasing window. If you'd like further information on the available strategies, please refer to our recorded webinar on the subject or contact info@crowncommercial.gov.uk. Primary objective of the risk team that me and Michael are on is to ensure effective and prudent delivery of each of the agreed strategies on behalf of you, our customers. In addition to ongoing active risk management that we're doing all the time, business as usual, we operate a number of different risk controls for all of our strategies. All of these controls are approved by our external governance board of customer representatives, and they have full visibility of the team's compliance for the purpose of transparency and assurance. The controls cover a variety of different approaches and broadly exist to ensure that trading is being effectively spread across the purchasing windows that we saw before. But also, they're assuring that actions are taken in response to a rising market. The stop loss in particular exists to protect against this risk. If you look at the chart there, it shows an example of the stop loss in action. Note that as the green and orange market prices rising towards the stop loss level in December 2021, they hit that and almost all of the volume is bought. And then you'll see the black line ongoing from that, which is our achieved price, is much more static. That budget has been locked in. Risk controls can work very well in protecting budgets and assuring these strategic aims. However, we cannot simply assume that they'll be the best solution for all conditions, and we must regularly review our approach. The markets right now are very challenging, and this isn't just because of the high prices. Volatility and liquidity present very meaningful complications in managing risk that we'll be exploring throughout the rest of this presentation. Because of these complications, I'll note now, and we'll revisit later, our governance board has approved the suspension of hard stop loss triggers. To mitigate this risk, an alternative measure of stricter minimum mandatory buying schedule has been implemented in the meantime. So my colleague will now walk you through what do we mean by volatility.
So yeah, you've probably heard the term volatility used in other contexts, meaning something like changing quickly, frequently, unpredictably. It's basically got the same meaning here when used in relation to commodity prices. It's a measure of the magnitude and the frequency of price changes over time. That's how much the prices are changing by and how often they're making these changes. Volatility is high when the price makes repeated changes by large amounts over the time period that you're measuring. One of our standard measurements of volatility looks at a 60-day period. In this time, the price can be increasing, decreasing, switching between the two. This is a point that some people can be confused about. It's a measure of how much the prices are moving by, and not just a measure that the prices are high or the prices are low. Prices can be highly volatile even if the prices are low, just as easily as they can be highly volatile if the prices are high. As you can see in the chart, which shows both the price and the 60-day measure of price volatility for summer 23 forward gas contract, there are peaks and troughs in volatility that don't align simply to prices rising or falling. Volatility is calculated as a standard deviation over a given period at time. I won't go into too much depth as I don't want to bore you with a mathematical formula, but I have included a typical formula for calculating standard deviation for a series of prices. Ultimately, it's tracking how much the price differs from the average price over the given period. So how volatile have energy markets been? What have you been used to? The charts show the price volatility for summer 23 power and gas contracts. They cover from April 2019 right through up to the end of 2021. And as you can see, they look fairly flat, especially through 2019 and 2020. Through to the end of December 2021, both power and gas sit comfortably below around 2%. But come the end of 2021, volatility is increasing, with gas price volatility reaching the 3% mark. This might be the first signs of things to come, if you remember the small chart on the previous slide. And how volatile is the current energy market? Well, the chart will give you an idea of what we've been working with more recently. This also shows the summer 23 gas and power forward contracts, and it covers the same time period as the previous charts, but it extends all the way through to the end of March 2023. The section inside the purple box, as you'll see, is the data that was shown on the previous charts on the previous slide. In broader context, you could say that the spike at the end of 2021 seems insignificant in comparison to what follows. Even the lowest level of volatility in the last 12 to 15 months remains higher than the 2% that we were comfortably below in the preceding years. So while volatility has leveled off somewhat this year, it's leveled off around 4 to 5%, depending on the commodity, which is still significantly higher than the highest peaks we saw for the same contract prior to 2022. So what affects volatility? Well, as you'd expect, there are many factors that impact the prices in the UK energy markets, and these can be both local and global factors. Anything that has an impact on the supply of energy or the demand for energy can drive price movements. Uncertainty is a big contributing factor to price volatility. If there's a potential for a certain situation to cause prices to make a large movement, even if they currently aren't, this can cause prices to become quite volatile in anticipation. One of the more obvious uncertainties that you'll be familiar with is the weather. It can influence consumption and demand in obvious ways, such as putting the heating on in the cold weather or putting an aircon on in hot weather. But the weather can also influence the supply side of things in ways you might not have considered. Low wind speeds mean less wind generation. Lower rainfall or drought conditions mean there's less hydropower that can be generated. And even fossil fuels can be affected. So extreme weather conditions can have an impact on drilling, for example, and LNG tankers cannot safely dock during high winds or high swells. Another major uncertainty in the global political is the global political situation. Decisions made in one country can have an impact on energy supply in another. Obviously, the war in Ukraine recently has been a major factor in the recent price volatility we've seen, and it's extremely difficult to predict when and how either the UK energy market or the wider European energy markets will be impacted by these events. One of the knock-on effects of highly volatile prices is market participants perhaps being less comfortable to enter the market. They may become reluctant to buy or sell. This results in a reduction in liquidity, as we briefly touched on and we'll cover a little later on. This reduction in liquidity has its own knock-on effect of adding uncertainty to the market, which can again be a factor in driving up the price volatility.
So I'll quickly cover how the volatility itself can impact our risk controls. Generally, any risk control we have linked to market prices will be implemented to protect budgets from rising costs or take advantage of low costs. In either case, the intention would be to act in response to indications of a directional trend. In the case of our stop loss, the aim is to trigger mandatory purchasing if the market was to rise to a certain level, protecting from any further rises. While it's always been the case that prices could retrace soon after a stop loss is triggered, there is no absolutely perfect solution that could be put in place there. Generally, it's worked very well. However, prolonged periods of high volatility introduce a great deal more noise into measurements of market positions. This means that the likelihood of hitting a trigger simply due to large swings up and down in a short period of time is amplified, to the point where it's a near certainty over a period of weeks that it would happen, even if prices were not trending upwards overall. Consider the hypothetical chart on the slide there. It's effectively an arbitrary point being triggered, even though the trend is downwards. A likely result of operating a hard stop loss trigger in such an environment could be an achieved price reflective of such an arbitrary point of time at which the price was hit and extensive buying was made compliant. This would conflict with the strategic aim that I've touched on of our forward hedging over a purchasing window, especially for our longer term baskets. Now, Michael will take you through what we mean by liquidity.
So we mentioned it earlier, but what does liquidity mean? Basically, it refers to how easy it is to buy or sell a commodity without having a large impact on the market. So if liquidity is thin, which is a term we use to describe not much liquidity, this means it's difficult to buy the forward contracts that we need to buy. And this difficulty can be increased on the further dated contracts, which are part of our buying for our long-term strategies. Higher levels of liquidity are good for the market participants. It allows sellers more easily to find a buyer and allows buyers to buy at a price they find acceptable. But ultimately, it's difficult to quantify liquidity. We can't put a number on it in much like in the way we could with volatility. There are a number of indicators we can look at which give us a good indication of market liquidity. One of the most important for us is the experience of our traders. So they've got vision of the market, they're interacting with it on a daily basis. They develop an understanding of the contracts in which they can easily buy volume and which ones they struggle at the current time. And they'll also quickly become aware of liquidity improving or dropping off as they're interacting with the market so frequently. Another indicator we can look at is known as the bid-ask spread. So a bid is a buyer who is making an offer to purchase at a price they consider desirable, and the ask is a seller offering to sell their commodity at a price that they consider acceptable. The spread is the difference between the highest bid and the lowest ask for a given commodity. A high spread indicates that the current market price is higher than buyers are willing to go. But obviously a low spread means that both buyers and sellers are happy with the market price. High price volatility can be an indicator of participants' hesitance to trade. As we looked at earlier, the volatility can make things difficult to predict. So we would often, not always, but often expect buyers and sellers to want to wait to see if the prices settle. And another indicator that we think is quite interesting is the total volume of a commodity traded during a given period. So ultimately, a large amount of volume being traded on a regular basis is very often seen as the best indicator that a market's liquid. So the UK energy market and how liquid do we think it is? We've got the total traded volume in the UK energy market from the beginning of 2014 through to the end of 2022. The UK gas is the chart at the top in blue, and the UK power contracts are at the bottom in orange. From around 2015, 2016, we see a fairly steady decline in total volume traded per month that continues through to the end of the chart at the end of 2022. And I can put that into some figures. In around 2018, UK gas was trading at approximately 700 terawatt hours per month, and at the end of 2022, that was down to around 200 terawatt hours per month. There's a similar but less severe decline in electricity, dropping from around 80 terawatt hours per month to around half that in the same time period. And then the European markets. So these are basically the same chart as the previous slide, but showing all of the European power markets. I will note that these do not include the UK. So like once again, the gas volume traded across Europe is the top chart in blue, and the power is at the bottom in orange. You can see a marked decline starting early in 2021, which is when we saw pensions start to rise in the Ukraine situation. And then you see another decline start early in 2022 when the war actually began.
So it's me again, and I will quickly take you through how the thin liquidity can be impacting our risk controls. Fundamentally, it impacts almost all of them on one way or another, because most of our risk controls will be mandating some amount of buying. And when you have a harder time buying volume, it's going to need to be considered with any risk controls. Several of our controls do it in some manner, such as our strategy gates, which require a certain percentage of forecast demand is purchased before specific dates across a purchasing window. But in cases like that, and most of the others, the minimum requirements are spread out sufficiently over time that our analysis shows they're still achievable in the current conditions with regards to liquidity. However, in the case of a stop loss, a huge volume becomes mandatory to buy in as short a time as possible if we hit one of those triggers. This can be extremely challenging to execute when liquidity is thin, as it has been in recent months, especially when you're buying energy for years and years in advance, where there may be very little market activity at all at any given time. Diving into the markets to try and secure volume at any cost can also easily have the effect of further driving up prices, which would be disadvantageous not only to the CCS portfolio, but for other energy users participating in the markets. This could even add to the potential feedback loop, which Michael outlined earlier, between volatility and liquidity, worsening the ongoing situation. So how have we been adapting to these challenges? As touched on throughout the presentation, the high volatility and thin liquidity have led us to suspend the hard stop loss triggers. This has been done with the approval and oversight of our external governance board of customer representatives. In the current conditions, it's simply too likely that stop losses could be triggered at a totally arbitrary point by the highly volatile price movements, and that it would then be difficult to impossible to quickly buy this volume without adverse effects on the price for our own purchasing and for other users in the market. This recommendation was made on the basis of in-depth analysis in the team of historical and current market conditions and modeling of future eventualities. The risk team is always actively monitoring the markets and undertaking analysis like this to ensure that all of our assumptions, policies, and controls are effectively protecting customers' budgets and delivering the agreed strategies. Our intention is to bring the formal stop loss triggers back into operation as soon as the market conditions allow. In the meantime, to mitigate increased risk exposure while they're suspended, we recommended to, and the governance board has approved the implementation of a stricter minimum buying schedule for every month of purchasing. We've balanced this minimum schedule around realistically achievable volumes given the liquidity conditions, assurance of reduced exposure to these short-term price spikes, but also allowing our trading team to utilize their industry expertise and take advantage of market liquidity as and when it may materialize. It should also be noted that though we have suspended the mandatory buying triggered by a stop loss, we're still measuring, reporting and monitoring the control, and we can elect to take action if that level is reached and the conditions in the market allow it. So in closing, I'd like to say that it's some relief to see wholesale prices falling significantly from the extreme high levels seen in 2022. However, while we have every hope that the trend will continue, prices are still elevated compared to the pre-crisis levels considered by many to represent a new normal. The highly volatile conditions, easily exacerbated by thin liquidity, mean that things could shoot up again easily in the event of a shock to a market, which could come from any of a wide variety of factors. Complacency could be very dangerous, but the risk team will continue to be vigilant, monitor market developments, and ensure that CCS is delivering value to all of our customers. So yeah, thank you very much for your time today, and we hope this information has been useful to you. If you have any questions, please don't hesitate to contact us at info@crowncommercial.gov.uk. Goodbye.